It started with a gap, not in the markets, but in the world's funding calendar. A billion-dollar sovereign deal that should have priced in dollars simply didn't show up. No cancellation, no explanation. It was replaced overnight by a yuan tranche so large that even veteran debt desks had to check the order book twice. By morning, 4 major central banks quietly shifted their hedges. The U.S. Treasury's overnight demand thinned, and the dollar's role in global funding flickered in a way no algorithm could hide. For the first time in decades, the world behaved as if the dollar wasn't the default, and the real shock wasn't the move itself, but how calmly the system absorbed it. The dollar has fallen close to 10% this year, the steepest decline since the early 1970s, according to multiple financial agencies. Investors once treated it as an anchor. Now it trades like a risk asset, moving with each new deficit projection and rate cut. The Federal Reserve is expected to ease again soon, but that brings its own cost. Lower rates mean cheaper borrowing, yet they also accelerate the global pivot away from dollar-denominated debt. Non-U.S. sovereigns have cut their dollar borrowing nearly 1/5 this year to roughly $86 billion. For the first time in 3 years, issuance is falling instead of rising. Finance ministries from Riyadh to Brasilia are experimenting with local currency and euro debt. The shift is pragmatic, not ideological. Dollar liabilities have become more volatile and harder to hedge. Indonesia took the lead this month with its first sovereign bond priced in Chinese yuan. 6 billion renminbi listed in Singapore, managed by major international banks. Officials called it diversification, but markets read it as a milestone. The issue was oversubscribed within hours, proof that global investors now view yuan debt as stable and liquid. In Hong Kong, a trader leans toward his screen as yuan bids tighten. Offshore renminbi bonds, dim sum notes, are on track for a record year. Analysts estimate total issuance has exceeded 470 billion yuan, with yields well below equivalent dollar paper. Technology giants like Tencent and Meituan have tapped these markets for funding, and state-linked funds in Europe are beginning to follow. China's export performance underpins this surge. Exports rose more than 8% in September, despite shrinking shipments to the United States. Trade with Southeast Asia and Europe surged, deepening the natural flow of renminbi settlement across supply chains that now bypass U.S. ports. Economists in London describe it as a quiet rewiring of global commerce. Besant's Tokyo visit underscored Washington's unease. Japanese officials were urged to maintain sound policy, a coded appeal to stabilize exchange rates. He avoided pressing for rate hikes. His real objective was to prevent further dollar decline. Inside the ministry, one official remarked that it felt like watching a man hold back a tide with his hands. At home, the fiscal math is suffocating. The U.S. deficit remains near $1.8 trillion, barely improved from last year. Interest costs have soared beyond $1 trillion, roughly a quarter of total revenue. Tariffs have boosted customs receipts by more than half since the last administration, but they barely dent the shortfall created by social programs, defense spending, and debt service. Analysts warn that monetary policy is once again serving fiscal survival, not economic stability. The dollar's credibility weakens as these numbers compound. Every rate cut erodes its carry advantage. Every spending surge confirms investor doubts. The Wall Street community describes it as fiscal dominance in real time. For Washington, the dilemma is brutal. Keep rates high and risk recession, or cut them and accelerate dollar outflows. Meanwhile, the yuan is gaining strength. Chinese banks sold more than $50 billion of foreign currency to corporate clients in a single month as exporters and importers converted earnings back into renminbi. Beijing appears comfortable with the appreciation. Tariffs of 10 to 30% on Chinese goods mean that even a stronger yuan doesn't erase price competitiveness. As one economist noted, when trade barriers replace exchange rates as the price lever, the currency can afford to rise. Europe's role in this transition is expanding too. Multinationals like Mercedes, L'Oreal, and Volkswagen now earn between 1/5 and 2/5 of their global revenue in China. Because Beijing keeps tariffs low on European imports, many of those transactions settle in euros or yuan. The European Central Bank's internal data show a steady uptick in renminbi invoicing, particularly in automotive and luxury goods sectors. For emerging economies, the pattern is clear. When their exports to China exceed those to the United States, the incentive to borrow and settle in yuan grows automatically. Currency choice has become an extension of trade geography. Market desks from London to Singapore are adjusting in real time. Hedging costs for holding dollars have plunged, prompting European funds to lock in protection against further declines. This rise in hedged positions reduces unhedged demand for U.S. assets and deepens the downward loop. Analysts at several global banks describe it as a self-correcting sell-off. The weaker the dollar, the less reason to hold it. The renminbi's infrastructure is catching up fast. The cross-border interbank payment system, which is China's clearing network, has expanded by more than 30% over the past year, surpassing early benchmarks for international transactions. The International Monetary Fund's latest reserve tables show small but steady increases in the yuan's share of global holdings, chipping away at the dollar's long-standing majority. Emerging market borrowers are not only reducing dollar debt, they're rewriting the playbook altogether. The most recent cut of International Monetary Fund reserve assets data shows the Chinese yuan and Australian dollar each gained about 0.03 percentage points of global reserve share in the latest quarter, while the US dollar lost roughly 0.12 points, lowering its share to about 56.3% of global reserves. The trend signals nuance. The dollar remains dominant, but its cushion is thinning. Meanwhile, custodial holdings of US Treasuries at the New York Fed on behalf of foreign central banks have fallen to approximately $2.78 trillion. The lowest since 2012 and down about $130 billion in just 2 months, hinting that foreign official demand for long-dated dollar assets may be cooling. The yuan is not waiting for formal declarations. Between January and June, commercial banks sold a record $132.5 billion of dollar-yuan options on behalf of clients, while the yuan itself strengthened around 1.9% against the dollar, even though the dollar index dropped nearly 11%. That kind of one-way sensitivity suggests firms and governments are hedging dollar exposure and embracing yuan risk as manageable. China's regulators have said publicly that the country has the conditions to maintain a stable yuan, citing ample policy tools and foreign exchange reserves. In practical terms, Beijing appears prepared for a gradual uplift of the currency rather than a defensive collapse. Even traditional metrics of safety are shifting. A survey of 75 central banks found a net 30% expect to increase yuan holdings over the next decade, and reserve managers project the yuan's share of global reserves could triple to about 6%. At the same time, global debt is ballooning. The Institute of International Finance reports the worldwide debt stock reached $337.7 trillion by the end of the second quarter, driven by a weaker dollar, softer global funding conditions, and higher G7 and China debt in US dollar terms. Emerging market debt alone exceeded $109 trillion, and the redemption wall for bonds and loans in the remainder of the year is about $3.2 trillion. The shift in funding flows is, pretty tangible. One major Asian exporter told investors that borrowing in yuan matches our Chinese partner receipts and cuts FX hedging costs. A sovereign treasurer admitted their renminbi bond priced cheaper and attracted more demand than the dollar alternative. The implication here is that the calculus is no longer ideological, it's arithmetic. China's digital currency push adds fuel. Beijing is exploring introduction of yuan-backed stablecoins to enhance cross-border usage of the currency, which is a significant pivot from prior caution on crypto and digital assets. Meanwhile, the People's Bank of China is vocal about promoting a multipolar currency system, rather than relying solely on the dollar. These changes are piling up beneath the surface of major auctions. While there are still large dollar bond deals, some even record-sized, the margins and investor depth in renminbi paper are improving. The arbitrage between borrowing in yuan and earning in yuan is narrowing. This is not bull market hype. Weakening dollar carry, rising hedging costs for long dollar liabilities, and an expanding pool of borrowers who earn scale in Asia and China mean a one-way drift toward non-dollar financing is underway. If a sovereign issuer that earns rubles, yuan, or local Asian currency can borrow and repay in the same, the currency mismatch risk drops, and so does the incentive to pick dollars. In short, the plumbing is shifting, and fast. As exporters, importers, sovereigns, and corporates all adjust funding behavior, the dollar's role as global funding currency is under structural pressure, not from a single policy shock, but from converging flows, hedges, and trade settlement inertia. The question now is how deeply dollar markets will feel the consequence when the next crisis hits, and whether the shift away from the dollar will accelerate from incremental to exponential. Beijing has also lifted limits on offshore yuan bond trading in Hong Kong and announced plans for yuan-denominated government bond futures, tools designed to give investors more depth and liquidity. Officials describe it as building the plumbing of a reserve currency rather than declaring one. Across emerging markets, treasurers are paying attention. One Asian exporter said his firm now borrows in yuan because it matches receipts from Chinese buyers and eliminates hedging costs. Another sovereign finance director admitted their renminbi issue priced cheaper than expected and drew more orders than a comparable dollar bond. All of this signals structural change rather than spectacle. The dollar remains the dominant currency, but its safe zone status is narrowing. For decades, U.S. deficits could be ignored because global demand for dollar assets seemed infinite. Now, as Yuan auctions clear easily in Hong Kong while U.S. Treasury bids thin in Washington, that assumption is being tested. As Besant's plane lifts off for Seoul, screens across Asia flicker with currency quotes yuan steady, dollar lower. Traders barely look up anymore. The shift feels gradual, inevitable. The question is no longer whether BRICS nations are rejecting dollar loans, but how soon the rest of the world begins following their example. When the dust settles, the most unsettling part isn't the yuan auctions, the shrinking dollar share, or the thinning treasury demand. It's the realization that the global system didn't resist any of it. No emergency meetings, no rescue bids, no last-minute scramble to save the old order. The shift happened in plain sight, and the world treated it like routine housekeeping. That's the real fracture, a currency superpower losing ground not through confrontation but through indifference. Because once the world stops defending the dollar by default, it becomes impossible to measure how quickly a reserve currency can slip until the moment its absence is already priced in. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.